Hello, Dynamic Directions. Welcome to the first ever coronavirus update. As you can see, I'm taking every precaution with your portfolio. If you could only see Ben working in a hazmat suit, you would understand the level of seriousness we are taking for this outbreak. As a reminder, when washing your hands, use hot water and count through the alphabet to ensure proper cleaning. Let's get into discussing serious topics about the market at hand. First and foremost, many of you have been talking to your Dynamic Direction coaches about what are we doing with the current market volatile market environment. Specifically, let's look at the big picture, starting with the epicenter of this disaster. First and foremost, I think the most worrisome element in this is China. Specifically speaking, you've had several 100 million people out of work for between a month to 6 weeks. That means no paycheck. That's a lot of dry tinder, so to speak, for a match of revolution to catch on in that area. To this point, there's no reports of that, but that's a major concern. If everything's okay there, that's going to be a lot of pent-up demand for work. So as China clears the hurdle, and really since February 18th, the number of worldwide recoveries from coronavirus has exceeded the amount of new infections. If this continues, these Chinese factories may get online very quickly if they're not already online, and they may be running 24 hours a day, 7 days a week until the global supply chain is restored. That's point number one. Point number two, let's look at where we are in the U.S. as it pertains to the financial aftermath once we're past the outbreak and potential clearing the virus hurdle. The main long-standing damage, or maybe benefit, obviously at this point looks like interest rates. As of the date of this taping, the 10-year rate is under 1% at literally 0.98%, and it has hit 0.90 in yesterday's trading. This is unheard of. That's going to make it harder for banks and insurance companies to make money. So that's primarily a negative headwind in that area. The beneficiaries of these low rates would be REITs and private equity companies. If you've noticed the trading throughout the day, you'll notice the REITs have held up pretty well, as have the private equity companies such as TPG Specialty Lending and Blackstone, to name a few. So that's one area of potential heartbreak, and another area potentially doing better because of this low rate environment. Now let's look at the energy patch. Energy stocks have been hit the hardest in this downturn due to demand destruction fears and a slowdown in the general global economy. West Texas crude, as of this taping, is under $47 a share. We had been positive most of the day. We've turned negative. You've got Chevron trading under 100, BP trading under $33. That's not to say these oil companies can't make money, but definitely we're going to have to see a lot of global growth before the crude oil shifts back above $50 to $60 a barrel. Other areas that are going to be hit extremely hard are going to be tourist, travel type companies. You're looking at airline stocks, cruise stocks. I know Warren Buffett has a cruise line in his intrinsic value portfolio. It's been absolutely battered. It'll be interesting to see what happens when he comes out with his new picks the middle of this month, and if he doubles down or if he just swallows the frog and moves out of that transaction. Let's look at the overall picture. Most diversified portfolios that we're running have held up very well. I would say part of that is a measure of how diversified we are, and we've been big believers in gold to the tune of usually around 10% to 15% in most clients' portfolios. We've been a big believer in REITs, and as aforementioned, those have held up pretty well. Generally, any type of fixed income instrument has held up in this environment as long as it's not credit related. So your shorter term, highly rated corporate bonds and treasury funds have rallied probably to historic highs compared to what's been going on. So if you're fully diversified, most of your clients, if they're like mine, they're calling in here thinking, this isn't near as bad as what I thought. And let's look at the fixed income opportunities. If you're a believer that this entire trade war and now the coronavirus is a wake-up call that more of our goods need to be manufactured in places other than China, you can follow me that those places where they'll be manufactured in the future will probably be a more expensive place to operate than mainland China. That's why those companies went there to begin with. That will mean companies will have to have higher prices on their goods for the consumers to pay, which will lead to, I think, a little bit of an inflationary move. We bought tips in December. They are up, in some cases, almost 4% year to date. I think every bit of this virus, especially with the relocation of the supply chain out of China, is going to be an inflationary move in the U.S. So in our fixed income portfolios, we're really looking to probably go more into tips, even more than we have, as a way to take advantage of probably a wave of inflation that may be coming down the road. So let's go on and look at kind of two potential scenarios here. Let's talk about the worst case first of all. I do think the worst case scenario is this is a catalyst for some type of revolution to go on in China. If that's the case, this would mean huge global supply dislocations and as well as global demand dislocations out of the People's Republic. There's no indication that that is happening, but I think it's part of our job to understand what are kind of the worst case scenarios, and I can see that as worst case scenario number one. Worst case scenario number two is a massive outbreak in the Western world. The Western countries aren't equipped like China or Singapore, where they can just shut down huge swaths of their city or their country and say, we're going to quarantine you. Most of our citizens won't take that. And the disease, really, once it hits a certain number of people, a quarantine really doesn't work because most healthy people are going to get through this. And unfortunately, the mortality rate on this looks like it's somewhere between 2 to 3%, depending on which statistics that you see. I almost hate to say it, but this nursing home outside of Seattle will be a very good test case because you have the most vulnerable people that we have in our society there. They're trapped almost like those cruise ship passengers, but obviously because they're in a nursing facility, they've got some type of underlying health ailment. And we will see just how much more lethal this coronavirus can be than just with the general population. Now, that's worst case scenario number two, because that you'd have a lot of demand destruction if the U.S. is closed up for business for an extended period of time. Now, let's look at probably what the best case scenario is. I think the best case scenario is this coronavirus follows what most other dread disease like Ebola follow. Usually they peak at about week 10 to 11 with infections and start scaling back where you have more recoveries at the tail end of the bell-shaped curve, so to speak, along with more deaths. That would mean that in Italy, for example, which is a really good test case, the first person stepped forward, first diagnosis was January 31st. I'd say it's reasonable to say the person was infected probably at least a week before that, maybe two. So if you go a week in January, you've got 4 weeks in February. By the first week in April, if the tide looks like it's turning to where there's fewer infections in Italy, I would think it'd be a reasonable explanation that this is following the normal disease pattern. In China, that's what it looks like. Definitely looks like China had a spike probably around February 15th. That's a real happy Valentine's Day. And if you go work backwards from that date with China, they started discussing this openly at the end of December. It would make sense probably somewhere a little bit before Christmas is when the first Chinese got infected, and by 10 weeks later we're in the middle of February. So that would be kind of the best case scenario. You get a lot of pent-up demand for goods. You've got a lot of Chinese workers wanting to work as much overtime as they can to replace the income they lost during the quarantine. And the global economy gets back to some type of normal footing. And at the whole time, there's another operation going on in the biotech industry to find a vaccine or a possible cure for the coronavirus. That's probably the best case scenario. More than likely, what will happen is somewhere between the two, and I think from country to country, depending on what types of steps are taken to stop the spread, you'll get different results. Given the diversity of the United States, it would not be crazy to think some pockets of the country are hit worse than others. More than likely, probably what's on your coast would be hit first, rather than kind of where we are in Bunker Central in Kentucky. So that bears worth watching out. But we've kind of given you a lay of the land on what we're doing. Look for positives in REITs, private equity, obviously gold. I think it's an opportunity to look at the balance sheet of the companies that you're invested in. Finally, if you've been battling out with the Vanguardians of the world or the indexers of the world, you may want to do some research over the weekend. If you look at how the actual indexes are trading and where the actual biggest index funds are trading, you're going to see a gap that emerges that's pretty wide. They talked about this at the Forbes conference last Tuesday, and this has been where we are. Currently today, the S&P 500 index is up 3.05%. The SPDR from State Street is up 3.24, so it's outperformed. The Vanguard 500 is up 3.16, so it's outperformed. If you go back and look on days where we had steep downturns, such as yesterday or last week, you would see almost some cases we observed a 50 basis point differential between what the market was down and what the indexes were down, with the index funds being down between 40 and 50 basis points more than the index at any given time. This will get more news flow and news examination once this crisis is over with and the panic has passed. But this type of high volatility is going to reveal some cracks in the indexer's armor. Remember, those funds that are supposedly super cheap or free, it costs them money to trade stocks like anybody else. In these areas of high volatility, it's going to cost them even more, and it's going to drive their expense structure up. And at some point, people will not be getting what they think they're getting. So take a look at this, study it, bring it up for those clients of yours that want to be in the low-cost provider alternative, because that would be another really good arrow in your quiver. Now, we make light of the disease because here in Kentucky we haven't been affected. We don't mean to offend anyone with our show of what we did, but let's keep in mind, we need to look on the bright side of this. America is the greatest country on earth. We have the smartest population. We will find a way around this. So let's keep looking on the bright side. If you have any questions, reach out to your D2 coaches or contact me directly. And if we need to do this again soon, we'll do it next week. Thank you, guys.